If your money is sitting in cash because you're waiting for the perfect moment to invest, you're probably running the most expensive strategy in America. In 2026, the boring 3-fund portfolio may be beating panic, predictions, and procrastination all at once. And that sounds ridiculous, right? Because cash feels safe. Cash feels smart. Cash feels like you're being disciplined while the Fed keeps everyone guessing on rate cuts, inflation refuses to fully die, and the market keeps snapping up, then down, then back up again. But safety and wealth are not the same thing. According to the Bureau of Labor Statistics, inflation has cooled from its peak, but prices are still far above where they were just a few years ago. The damage stuck. Rent stuck. Insurance stuck. Groceries stuck. So if your cash is earning a decent APY in a high-yield savings account, or HYSA, that might feel like progress. But if that cash becomes your permanent investing plan, inflation is still quietly chewing through your future. And honestly, the real culprit is not that you're lazy. It's that the system trained you to confuse waiting with wisdom. Banks love idle cash. Financial media loves drama. Your brain loves the illusion of control. So you sit there, half invested in headlines, fully invested in hesitation. I get it. I really do. I used to do a smaller version of this exact mistake. I would keep extra money on the sidelines thinking I was one clean entry away from looking like a genius. Instead, I bought late, sold novice, and left thousands doing absolutely nothing. Not because I was dumb, because I wanted certainty in a system that doesn't offer it. So ask yourself this: if nobody can consistently predict the perfect entry, why are millions of people building their entire strategy around finding it? Why does the advice always sound smart until you calculate the opportunity cost? Why does the math nobody teaches you keep favoring the boring people? Because boring works. Not sexy, not viral, not cocktail party impressive, just effective. The thesis of this video is simple. In 2026, with rate cut uncertainty, sticky inflation, and exhausted investors bouncing between cash and random stock picks, the 3-fund portfolio is winning because it removes the need to be right about the next headline. It lets diversification, low fees, and time do the heavy lifting while everyone else burns energy guessing. And stick with me, because the next number is going to make you uncomfortable. Morningstar's long-term data keeps showing the same ugly truth. Investor returns often trail fund returns because people miss time entries and exits. The investment may do fine, the investor does not. That gap is behavior. That gap is fear. That gap is chasing and bailing. The 3-fund portfolio is basically a system designed to protect you from yourself. What is it? 3 simple pieces. A total U.S. stock market fund, like VTI or SCHB, a total international stock market fund, like VXUS, and a U.S. bond fund, like BND or AGG. That's it. You own American business, international business, and a stabilizer that doesn't move like stocks. This is where most people roll their eyes. They hear international and think underperformance. They hear bonds and think boring old person asset. They hear total market and think average. Good. Average is underrated when average beats your chaos. Think about the poor way versus the rich way to handle 2026. Poor way? Keep guessing. Sit in cash because the Fed might cut. Then buy after a rally because you got FOMO. Then sell part of it when CPI comes in hot. Then jump back into a money market fund when a recession headline pops. That's not strategy. That's quicksand with notifications. Rich way? Decide your allocation once. Maybe 70% stocks and 30% bonds. Or 80-20 if you're younger and can handle volatility. Split the stock side between US and international. Automate contributions through Fidelity, Vanguard, or Charles Schwab. Rebalance on a schedule. Keep moving. No prophecy required. And here's what most people miss about 2026 specifically. Cash is no longer obviously stupid in the short run, which is exactly why it became dangerous in the long run. When your HYSA pays 4% or your money market fund looks respectable, procrastination suddenly feels responsible. But if inflation stays sticky around the low to mid 3% range, taxes take a cut on taxable interest, and equities keep compounding through the noise, your temporary cash parking lot can quietly become a retirement delay machine. That is the beyond the obvious insight. In zero-rate years, cash looked obviously weak. In 2026, cash looks respectable enough to seduce you into staying there too long. That's the trap. I saw this with a cousin of mine after the 2022 mess. He got spooked, moved a chunk to cash, and kept saying he was waiting for clarity. Then 2023 ripped. Then 2024 got weird. Then 2025 was all chop and headlines. He kept waiting for the clean moment. By the time he felt comfortable, the market had already done a lot of the work without him. His mistake wasn't fear. It was demanding calm from an asset class that pays you for surviving chaos. The stock market is not a vending machine. It's a transfer machine. It transfers returns from impatient people to disciplined people. Let's put numbers on this. The Federal Reserve and Fed data made one thing obvious over the last few years. Policy uncertainty changes fast. Markets front-run those changes even faster. By the time rate cuts feel obvious on CNBC, prices have often already moved. S&P Dow Jones Indices data has shown again and again that missing just a small number of the market's best days can destroy long-term returns. And the cruel part? Many of those best days happen right next to the worst days. So the people waiting for things to settle down often miss both the rebound and the compounding. That's why the 3-fund portfolio matters now. It is not trying to beat uncertainty. It is built to survive it. Now let me show you the part that made me change how I think about cash entirely. The biggest risk in 2026 may not be volatility. It may be emotional paralysis dressed up as prudence. If you're 28, 32, 37, and you keep 6 figures in cash because you want the right time, every year you delay is not just a missed return. It's a smaller future snowball. Compound interest is your money making money while you sleep. Delay is you firing that employee before its first shift. So let me give you the blueprint. Step 1, choose your 3 funds and your target allocation today. Not next month, not after the next Fed meeting, today. If you want the simplest version, use a total US stock ETF like VTI, a total international ETF like VXUS, and a US bond ETF like BND. If you're inside a 401k, use the closest low-cost equivalents. Look for low expense ratios. That just means the annual fee the fund charges you. Lower is better because fees are a leak, and leaks compound too. A reasonable starting point for many younger investors is 80% stocks, 20% bonds. Inside the stock slice, maybe 60% US and 20% international. If volatility wrecks your sleep, go 70-30. The perfect allocation is not the one that wins on paper. It's the one you can hold when the market acts insane. Step 2, automate the boring part so your emotions stop touching the money. Set up recurring investments at Vanguard, Fidelity, or Schwab. If your paycheck hits on Friday, invest every Monday. That's dollar cost averaging, or DCA. It means buying on a schedule instead of trying to outsmart the market. Some weeks you buy high, some weeks low. Over time, you buy reality instead of headlines. This matters even more in 2026 because investor exhaustion is real. People are tired of fake breakouts, tired of recession calls, tired of experts changing their tone every 6 weeks. Automation is not just convenient, it's psychological armor. And if you have access to tax-advantaged accounts, use them in order. Grab the employer match in your 401k first if you get one. That's free money. Then look at a Roth IRA if you're eligible. In 2026, contribution limits matter because every extra tax-advantaged dollar has decades to grow. If you qualify for a health savings account, or HSA, that account is a monster too. Tax deduction going in, tax-free growth, tax-free withdrawals for qualified medical expenses. That's rare air. Step 3, define exactly how and when you rebalance so you don't improvise during a panic. Rebalancing means bringing your portfolio back to target when one piece grows too large or too small. Maybe you check every 6 or 12 months. Maybe you rebalance when an asset class drifts 5 percentage points off target. That's it. Simple rules, no vibes. When US stocks rip and your allocation gets too aggressive, you trim a little and add to what lagged. When stocks drop and bonds hold steadier, your next contribution buys more stocks at cheaper prices. This is the escalator most people refuse to step on because it feels too boring. Meanwhile, lifestyle inflation is the escalator going down. Diversified investing is the one quietly taking you up. And yes, bonds deserve one more sentence because people still treat them like dead weight. In a whipsaw environment, bonds can reduce the size of your portfolio swings and give you dry powder for rebalancing. No, they won't usually beat stocks over 30 years. That's not their job. Their job is to keep you from blowing up your plan after a bad month. If you want to get fancy later, fine. Tilt towards small cap value. Add treasury inflation protected securities, or TIPS. Use a tax-efficient asset location strategy between taxable brokerage and retirement accounts. But none of that matters if you haven't mastered the plain vanilla version first. A lot of people want a complex portfolio because complexity feels like effort, and effort feels like intelligence. The market does not grade on effort. It grades on behavior. So what does the payoff look like? If you invest $500 a month into a low-cost, diversified portfolio and earn a long-term average around 8% before inflation, you're looking at roughly $745,000 after 30 years. Push that to $1,000 a month, and you're around $1.49 million. Not because you found the perfect stock, because you stopped interrupting the process. Compare that with the person who waits 5 years for the perfect entry. Same contribution, same return after they finally start. They can end up hundreds of thousands behind. That's the hidden bill for procrastination. Nobody sends you the invoice. Your future does. This is not about becoming rich overnight. It's about not staying fragile forever. It's about not hitting 45 with a good income, a tired brain, and a brokerage account that looks like a parking lot. It's about building a system that keeps working when you're busy, stressed, distracted, or tempted to be clever. Do you think buying a simple 3-fund portfolio right now beats waiting in cash for a better entry? Fight me in the comments. The next 60 seconds will change how you look at your paycheck. Like this video before we continue. Every paycheck is a vote. Cash says, I need certainty first. A 3-fund portfolio says, I accept uncertainty, because that's where the return comes from. One feels safer today. One usually builds freedom tomorrow. Excited? And if this clicked, subscribe. We're building a complete blueprint series, and the next pieces go deeper on Roth IRA allocation, HSA strategy, and how to stop lifestyle creep from eating every raise you get. We're building a complete blueprint series. Subscribe to catch every piece. The people who win with money in 2026 are not the ones with the hottest take. They're the ones with a repeatable system. Boring is not losing. Boring is compounding.